Thank you, Banco Central, for having this topic in the agenda. It's a very dear topic to us at FGC. We are a deposit insurer, so bank runs are main concerns for what we do. And we have here today 3 special speakers: Christoph Birch from Zurich Risk Bank, Wesley Borges from USP FGC, and Marcelo Rezende from the Federal Reserve Board. And we're going to start the works right now with Chris. Thank you. Take the floor.
Thanks a lot, Daniel. First of all, thanks a lot to the conference organizers for including our paper. I'm really looking forward to the great conference program. This presentation is on bank fragility and the incentives to manage risk. It's joint work with Tony Arnott and Agnese Leonello from the European Central Bank and with Robert Marcus from UC Davis. The usual disclaimer applies. Historically, panic-driven bank runs have been a recurring phenomenon, and recent episodes demonstrate that they are continuing concern for bank shareholders, depositors, and for regulators who may be concerned about the safety and soundness of banks. The US regional banking crisis of 2023 is a good example for panic-driven runs by uninsured depositors, which broke the Silicon Valley Bank and other mid-sized US banks. What is a banking panic? It's a situation where everybody wants to withdraw their funds before withdrawals by others leave the banks with no resources. Importantly, when depositors are coordinating on withdrawing their funds, a bank can fail because of illiquidity, even if it would otherwise have enough resources. Where does this banking instability come from? The first factor is the structure of liabilities and the role of the bank in maturity transformation. Specifically, the asset side typically has a longer duration than the liability side. A second source of instability is shocks to the value of bank assets. And this can be particularly problematic if the asset value under early liquidation is reduced. That is, if the banks have to liquidate some of their investments in order to pay off withdrawing depositors, and if this liquidation is costly and therefore a drag on the bank's resources. What is the role of risk management? Our starting point is the observation that many shocks to bank assets are at least partially anticipated, and a case in point is the increase in interest rates in the US during the last 2 years, which reduced the value of fixed income assets, but it was not entirely a surprise to banks. Moreover, managing many of this type of shocks is relatively easy to do, so there are instruments available to banks, and they're sufficiently sophisticated to do so, and yet many US regional banks fail to engage in any risk management activities. Starting from this observation and this motivation, what we do in this paper is we want to study how shocks to the value of bank assets affect bank fragility and thus the incentives of banks to engage in risk management activities. Specifically, we are interested in trying to find out what happens to the bank's incentives as the possible shocks it faces become more extreme. What we do is we develop a standard bank run model to study fragility following Diamond Dybvig and Goldstein-Pautzner, but we add first shocks to the interim value of bank assets. So you could think of this as temporary shocks to the bank assets, which might even keep the long-term valuation of the bank asset fixed. So think, for instance, of a temporary shock to interest rates. Second, we introduce contingent risk management tools that allow the bank to insure against this type of risk in a targeted way. And that's going to be the key ingredient in the paper that we will elaborate on. Moreover, we also include bank capital and deposit insurance. Of course, deposit insurance can only be partial. If everybody is fully insured and deposit insurance is fully credible, then there's not going to be any panic-driven bank runs. What are the main findings of our paper? First, we find that risk management tools, specifically the contingent risk management tools that we're interested in, reduce the likelihood of a run in the event of a negative shock to asset valuation. And that, of course, also holds for non-contingent risk management tools such as bank capital. And there is some existing literature by Xavier Vives and others that has looked on that and that we are building on. One important caveat that we find is that risk management failures by banks, so failures of banks to engage in contingent risk management instruments, occur precisely when the exposure to run risk is highest. It's optimal for banks to fail to engage in contingent risk management, but from a social point of view, there's going to be too many bank failures, and that's because of a moral hazard problem. So when we compare what is privately optimal for banks and what is optimal in a suitably chosen constrained planner problem, we see that there are too many bank failures. Third, we study the role of bank capital and deposit insurance, and we find that they have a differential impact on the bank's risk management choice. First, they are substitutes at the intensive margin. Because bank capital and deposit insurance are increasing bank stability, and this in turn is reducing the marginal incentives of banks to use contingent risk management tools. However, bank capital and deposit insurance are complements at the extensive margin. Apologies for the typo here on the slide. It's the extensive margin. And the intuition is that bank capital and deposit insurance are increasing the positive impact that risk management has on bank profits, which acts in a way as a catalyst for the establishment of a risk management desk. So, in other words, we have a differential effect, and the first bullet point A is about how much risk management to do. That's the intensive margin, and the bullet point B is going to be on whether or not to do any risk management at all. That's the extensive margin. Let me tell you briefly about the main ingredients of the model, and then I spent most time on the results. The model is relatively simple. We have a monopolistic bank that's endowed with capital, K units of capital and 1 minus K units of deposits. In an extension in the paper, we are endogenizing bank capital, but I won't say anything about that here in this presentation. The deposits have a face value. If withdrawn early, depositors can withdraw at par, so they are returned 1. And R2 larger than 1 is the endogenous repayment of depositors at day 2. Moreover, we assume that there's an exogenous fraction sigma of deposits that is insured. It is important that this deposit insurance is only partial. If everybody is insured, then there are not going to be any bank runs. The model has 3 dates. So at date 0, the bank has the funding from bank capital and deposits, which it first invests in a risky investment opportunity with a return theta times R, where theta is a uniformly distributed random variable. And the expected return on the investment project is larger than 1, so it's profitable for the bank to engage in this risky investment. Thereafter, the bank chooses its risk management effort set. And I will be more precise on that in a minute. The risk management effort set is going to help the bank to have more resources available in case needed when facing a low liquidation value. The liquidation value is realized at the beginning of date 1. It could be high or low, and it is observed by everyone. After that, the bank run stage takes place. In the bank run stage, depositors first receive a noisy private signal SI, which is given by theta plus some idiosyncratic noise term, and they decide whether or not to withdraw. So they don't directly observe the fundamental realization theta, but receive a noisy signal. If the signal is considerably favorable, they're going to decide not to withdraw, and if it's an unfavorable signal, they're going to decide to withdraw. If the bank faces withdrawal requests, it has to meet this withdrawal requests by divesting some of its risky investment. It can do so at the liquidation value, we assume that the liquidation values are smaller than 1, so it's going to be the case that early liquidation is going to be a drag on resource to the bank, and if there's too many, the bank is going to fail. If the bank doesn't fail, then at day 2 the remaining investment matures, the residual depositors are repaid, and at the end of the game consume. Let me now tell you something about the main novelty of this model, which is the risk management, which is chosen at date 0. So what we assume is that the bank selects a risk management effort Z, which is unobservable, and this allows it to increase the interim asset value under the negative shock, so in state L, when the liquidation value is low. Z is simply entering additively, and in the paper we look at different ways to do risk management, but that's what I will show you in the presentation. We assume that risk management activities don't come for free, but there's a cost to that. Specifically, we assume that there's a non-pecuniary cost of risk management, which comprises a variable cost and a fixed cost component. The variable cost component is involving this quadratic term here, and the fixed cost component is additive. When thinking about the variable cost component, you could think of costs that are representing search costs, costs for collateral needs, counterparty risk and hedging, but it could also be a proxy for the cost of monitoring assets and identifying resale markets. When thinking about the fixed cost, you could think of the overhead associated with employees that are tasked to manage risk and to identify risks. This fixed cost, importantly, in our paper can be arbitrarily small, and let's just think of it as the cost of setting up the risk management desk. One thing I'd like to mention is that the quadratic cost in the variable cost term is designed to make it really cheap initially to engage in risk management activities at the margin. And that's what we want. We really want to give the bank an incentive to do so. Now, having discussed the model, let me tell you about the main results that we derive. The model has to be solved backwards, and the interesting part of the model takes place at date 1, where there's the equilibrium of the withdrawal game. And we apply a global games methodology to derive the equilibrium run threshold theta star, and thus the run risk, which is defined as the probability that the realization of theta falls below this threshold theta star. Whenever that's the case, we're going to have panic runs where all depositors withdraw. If theta has a sufficiently favorable realization above this threshold, then nobody runs and the bank survives. We find when doing some comparative statics that is similar to previous work by Xavier Vives and others, that the probability of a run decreases in the level of bank capital K and also in the value of the interim asset. Moreover, we find that occurs at a diminishing rate. So the sensitivity of the run threshold is going to be particularly large if the level of capital or the level of the liquidation value is lower. Moreover, we find that the effects of capital and the liquidation value on the run risk are substitutable. This is basically in the sense that if you have a higher liquidation value, then the sensitivity of the run risk with respect to capital is reduced. So this is all quite intuitive, and we know some of this from the previous literature. And we also can find similar results when we look at deposit insurance. So deposit insurance is also going to be stabilizing here in this model, same as bank capital. And there is this substitutability with the liquidation value. Now, having discussed the game at date 1, let's have a look at the risk management incentives. So remember that the banks are choosing their risk management effort at date 0. So what you can see here on the slide, the first equation is the ex-ante bank profits. And the banks perfectly understand that if the negative shock is large and they don't do enough risk management, then this fundamental threshold theta L star might be very close to 1, and it might be very sensitive to the risk management choice. When solving the model, we first look at the first order condition, where you can see the marginal benefit and the marginal cost from risk management. Importantly, the marginal benefit is driven by the sensitivity of the run threshold with respect to the risk management choice. What do we find? When we denote as Z hat the solution to this equation 2, we find that the risk management level chosen is going to be positive, ignoring the fixed cost. We find that at the intensive margin, banks engage in more risk management effort if there's a lower liquidation value. However, they don't fully compensate for changes in the liquidation value. Moreover, capital and deposit insurance are substitutable at the intensive margin. Let's have a look at the graphical intuition for these results and then see how risk management failures can arise. So what you see here in this figure is you see the fundamental theta on the horizontal axis and the payoff of the bank on the vertical axis. So the risky long-term investment payoff is R times theta, and we have that it's higher for higher fundamental realizations and lower for lower fundamental realizations. There's a linear relationship. The promised repayment of depositors is given by 1 minus K times R2. So whenever the bank has insufficient resources, it's going to be insolvent even without panic runs. And if it has enough resources, it can survive. Now, if we introduce panic runs into the model, then in the L state with a low liquidation value, the panic runs are forcing interim liquidation of the asset, and that's going to be costly. As a result of that, the bank is going to be also insolvent, is going to fail in situations where it would otherwise have enough resources. So the run threshold theta star is to the right of this point where the bank has just enough resources, absent runs, to survive. Now what happens if this shock to the liquidation value is larger? So if the liquidation value L is lower, then we have that the region where bank runs occur increases, so theta star moves to the right. What can the bank do with risk management? Well, the bank with increasing its risk management effort can counteract this effect and can stabilize the bank, and that's essentially what you see here. When is it making sense for the bank to engage in risk management? In order to find that out, we have to compare the benefit for the bank from risk management in state L with the cost of risk management. And what we can already see here graphically is that if the negative shock to the liquidation value is larger, then the possible profits of the banks that it can achieve are compressed. And as a result of that, the benefit from risk management in state L is going to be compressed. And that's going to be the key mechanism behind the risk management failure. Formally, we find that there's going to exist a threshold for the liquidation value LL tilde, such that for a given combination of the fixed cost, which could be arbitrarily small, and this threshold, which is a function of the fixed cost, we have that whenever the liquidation value is below that, so if the negative shock is sufficiently large, we have that the bank optimally engages in no risk management. Instead, If L is above that threshold, the bank is engaging in risk management. So graphically, if we are focusing on the left panel, you can see here the interim asset value, L, on the horizontal axis, and the risk management intensity, Z star, on the vertical axis. You can see that as the liquidation value is reduced starting from the right, the bank has incentives to compensate for that, at least partially, by increasing its risk management effort. But if we reach that threshold, the risk management of the bank drops to zero. As a consequence of that, the bank is reducing the run probability in this range for higher liquidation values above the threshold by engaging in risk management, but is not doing any risk management below that threshold. When we look at the role of bank capital and deposit insurance, and I just got the sign that there's only 1 minute left, we find that this cutoff is actually in an interesting way affected by changes in bank capital and by changes in deposit insurance. Let's just focus on the case of bank capital. So what we find here in this graph is that for a higher level of bank capital, K prime, it is going to be the case that banks are engaging in less contingent risk management effort. That's the region where those are substitutes. However, at the extensive margin, the bank is even engaging in contingent risk management for lower values of the liquidation value in this interim region. So that's the extensive margin. So at the extensive margin here, bank capital and deposit insurance are a catalyst for risk management, whereas there's the substitutable relationship here. To conclude, negative shocks to the bank's interim asset value can cause instability. A bank's incentive to hedge this exposure depends first on what it stands to gain, and second, on whether it can recover the cost of managing the risk. For large enough negative shocks, banks rationally prefer to risk destructive runs rather than to bear the cost of setting up risk management operations. And when we compare that to a constrained planner benchmark, that's what I didn't have time to show you here, we see that due to moral hazard problems, there's going to be too many banking failures because of failures to engage in risk management. Regarding the role of bank capital and deposit insurance and risk management, we can see that they are substitutes along one dimension, but complements along another dimension. First, they reduce fragility and thus the marginal incentives to manage risks. That's the negative intensive margin effect. And second, they increase the returns to setting up a risk management desk, which is the positive extensive margin effect. Thanks a lot for your attention. Sorry for running a bit over time. I really look forward to Wesley's discussion.
Thank you, Chris. Now it's Wesley's turn. 10 minutes for reviewing and then 10 minutes for questions.
Good morning, everyone. Thank you so much for the organizing committee and for Christoph for the great paper. It was a very enjoyable read. And here the usual disclaimers applies that all views expressed in these discussions are my own and not those of FGC. And just to recap about the background and contribution of the paper, so we just saw recent pictures of banking failures that have underscored the critical impact that a shock in the interest asset value has on banking stability. And also, despite these almost anticipated negative effects of the shocks, many banks do not engage in risk management. And then the contribution of the paper would be to propose a framework to explain why this may be occurring. So in terms of the strengths of the paper, I think it is important to highlight that it provides a very rigorous theoretical framework that considers real case applications, especially related to the US regional banking crisis of 2023. And also it is a framework that helps understand the benefits of different tools that might be available to either the bank or the regulator, as Chris mentioned, the deposit insurance or banking capital. So I think it's, just would like to get more time here to give some comments and feedback. And yeah, I think it'd be really interesting to get a sensibility analysis of how these results would hold if we would consider more flexibility in the model with different types and heterogeneity in the agents for the banking sector. For example, if we have more than one type of bank rather than a monopolistic bank, and also risk aversions from the consumer and depositor side, I think this would be interesting to test the outputs and also the stability that the model showed to us. And also, I think it is interesting and important to address how regulatory differences and incentives impacts on financial systems, the systemically important financial institutions and non-systemically important financial institutions have. Because we already know, for Brazil example, we have different practice in different demands of regulatory for the systemically important financial institutions and also important financial institutions. So I think to have some kind of specific area dedicated to discuss this, I think would be beneficial also to explore more about this framework. And also to have here, although it may be a little subjective and difficult to put in a model for sure, but to account for different difficulties for banks to raise capital. If you have an institution that are listed or not, or a stakeholder that has more or less incentive to put capital and a bank in the group. So I think addressing the different challenges and difficulties in raising capital, I think this is also an interesting topic to discuss. And also, I think it is a more detailed discussion regarding, and with a dialogue with the literature regarding the impact of bank capital would be interesting because, as you mentioned in several sections, the trade-off that we have regarding banking capital that when raising, it could be beneficial to bank stability, but also could incur in concentration. It also could incur in elevated capital costs. So I think elaborating and discussing the results with the literature to test how these different proposals in the literature talks with the framework that it was established in the paper. I think it's very rich. It would certainly enrich the discussion and certainly also the policy debate around this area. So I think these are the main comments. Once again, it was a very enjoyable read. I think the paper has a lot of rigor implemented. So this is certainly a contribution to the literature in banking crisis and also risk management. And it's certainly also a framework that it can be built to adapt to different economies, like tuning some parameters for different economies. I think there's a lot of contribution to get from this framework. And also, as I mentioned, adding a detailed analysis related to the trade-offs of a higher capital requirement would certainly be very fruitful for a policy debate around these themes. Thanks so much, Chris. Thank you.
Thank you.
You can react from there.
Okay, I don't know if the microphone is working. Thanks a lot, Wesley, for the great comments. So there's certainly a couple of aspects that we definitely have to take on board, and most of them we are already working on. So regarding the sensitivity analysis, what we could do is we could introduce different types of depositors, and I don't have a good view yet on what aspects in terms of results could be most interesting there, but the key mechanics shouldn't be affected in terms of the kind of qualitative insights that I showed you today. Modeling risk aversion is quite hard, so we will for sure stay away for that, but that would be definitely important. In terms of bank heterogeneity, I think there's a lot of work that we still have to do. Also, we are thinking of what we don't have yet, to potentially have a section on testable implications where we really look at the extensive and intensive margin effect and try to reduce the distance between the model and the data in terms of trying to understand how heterogeneity in bank capital and exposure to shocks and other aspects could really relate to the type of insights we find at the intensive and extensive margins. So in a way we could locate different types of banks in the kind of graphs that I showed you, which would be informative for regulators. In this simple model I showed you, we have a monopolistic bank, so that's of course a strong assumption. What we can do is we can vary the outside options for depositors, but also for equity holders, and that's something that we didn't explore yet, but that's something on our list definitely to do. Thanks a lot.
So now we're going to open for questions, and just let me start with one. It's related to the point that Wesley was making. And thinking more from a policy perspective, when you have one monopolistic bank in an economy and you have a social planner, probably there is going to be a bailout, because the economy will not survive without the bank. So I would like to see your results for the non-systemic banks in your model when you have market power for a systemic bank, and what are the implications of risk management for the other banks, for the non-systemic banks. But just to have in mind when you're preparing the new versions of your paper. We have over there one question.
Okay, me here. I think your modeling of I think your modeling of risk management is a bit too reduced form, and I think I'm a bit in two minds about it, because I understand it, on the one hand it helps you, makes your life easier, but I think you might be missing some of the trade-offs, because then you have this quadratic cost, and then you can find an interior solution, it works beautifully, but I think that the trade-off will be something like you reduce risk, you also reduce your upside. It's not even clear that you have this beautiful internal thing, or you have some kind of bank thing. I think I would encourage you to try to do a bit more micro-founded, quote-unquote, modeling of the risk management, because then I think it would be more beautiful it would fit more beautifully into the model.
Let's get one more here.
Yeah. So you had bank capital and deposit insurance as the alternative to the risk management, but it seems to me like there's a third option missing, and that's the interbank market, because what you have is a Diamond-Dybvig model, which is really a very unrealistic model of bank runs, because what people do is literally take their bank deposits, put them in their mouth, and eat them. Right? And that's not what happens. What happens is I draw a check on my bank that I'm scared about and deposit it in another bank. At that point, that bank automatically lends back to my bank. That's settlement, right? It's automatic, but maybe on very unfavorable terms, and maybe it'll want to roll that over, et cetera, et cetera. But then the mechanics of the interbank market and the willingness of this other bank to hold that balance really matters, but that's not present because you're using a Diamond-Dybvig sort of setup.
Yeah. Let's take one more for the professor, then we'll go for a round of answers and go back to the next question. Professor, I think you should have to press the button over there.
Press?
Oh,
Yes,
good.
no.
Thank you.
Very nice model and insightful. And I go back to, in fact, to the first question. I think really it would be good to do some more micro foundation of the risk management, because I would say that the most immediate thing would be to think about why those banks do not hedge interest rate risk, right? And so, in fact, how does your technology may represent or not the hedging of interest rate risk, which has a cost, obviously, but is it represented by your cost function or not? Apart here, but this is not in your model, obviously, there are some regulatory aspects, for example, which are different in the US and in Europe, and in which in the same type of banks hedge more interest rate risk in Europe, but not in the US, and there are some reasons, some institutional reasons for that. No? And the second comment, but is more to think about potential extensions, also in this investment in risk management, which also has been kind of implicitly stated before, how would an expectation of a bailout play, right? And so on, how could you model, no, an expectation of a bailout in case of trouble, no? Because obviously this will affect your investment in risk management.
Your turn.
Thanks a lot for the comments. I think I'll start with the back, with the last one, and there was also quite some overlap. So bailout expectations, we didn't look at that yet. That was related also to your comment, that that's really something we should put on our list. What is high on our list, what we're currently working on is different ways of modeling risk management, and that's something we really have to, we are aware we have to think harder about, and specifically to try to understand under what type of assumptions the key qualitative inside of complete risk management failures falls apart, and whether that also might affect the intensive margin results. So that's something that we don't have a full answer yet, but we are working on it. Regarding the regulatory aspects, I didn't talk about it today because I didn't have time to talk about policy implications, and that's something where we should also do a little bit more still. It was quite interesting that in the EU they had stress tests where they looked at interest rate risk scenarios, whereas in the US they hadn't. And I think there are relevant implications for the design of stress tests and the deposit insurance. So for instance, you might want to make premia, for instance, contingent on banks engaging in setting up a risk management desk, for instance, which many regional banks actually in the US, they didn't have interest rate risk management desk to start with, right? So some things are observable, some things not, so maybe there's interesting insights here for regulators. But that's something that we have to explore definitely more. Regarding Michael's comment about the interbank market, I would argue that it's modeled in a reduced form, very reduced form, because the low liquidation value is a drain of resources, as would be, you know, the kind of mechanism that you explained. But of course, your mechanism you have in mind is much richer, so I'd acknowledge that. And then I think this was basically all comments, or did I forget something important? Your comment about bailouts was already in a way
addressed,
included, yeah.
Let's go for another round. Any questions over there?
I'd like to think about the policy implications of your results. For example, are you implying that regulatory capital requirements or the level of deposit insurance could be sensitive to the level of risk management effort that institutions put? It's a question. This is the policy implication that you have in mind?
More questions? So let's go for this one.
The first aspect in terms of policy implication is, I would argue that we really found out that there are this relevant extensive and intensive margin effects, and from the viewpoint of a regulator, when you think about bank behavior, you want to locate specific banks and specific banking models in that space. So in that way, our model, I think, is informative for regulators. When it comes to actual hands-on regulation. Yes, one aspect is the deposit insurance premium or deposit insurance coverage that you could make contingent on certain actions like the setting up a risk management desk. I think that non-contingent risk management tools like bank capital and things like setting up a risk management desk are quite observable, whereas the risk management effort is probably not very observable, so that's going to be much, much harder. But then it's good for you to know how incentives are, and that's something we hope our model can speak to.
Okay, so our time is up for this first paper. So let's go with the second one, Wesley. The floor is yours.
So once again, good morning, everyone. It is a great pleasure and honor to be here today. So my name is Wesley. Just would like to share with you some ideas from a paper called Systemic Risk Measures and Optimized Capital Requirement. And again, the usual disclaimers applies that all views expressed in this paper are my own or those of FTC or its staff. And to begin with this executive summary, this paper dives into the analysis of systemic risk measures and systemic risk in general for the Brazilian financial systems that considers also different channels of contagion. And we are dealing here with two different samples. One of reduced listed financial institutions, and a second consider all covered member financial institutions in the Brazilian financial market. And using only publicly available data from the central bank, we are able to estimate the loss distribution of the Brazilian economy, the probability of default of the deposit insurance agents, and also a capital adequacy ratio that could be thinking as an optimized one. And our results show that the DIA would be able to bail out 80% of the banking systems in 80-90% of the simulated scenarios, and also to reimburse all covered deposits in 97% of the simulated scenarios. And also in terms of the optimized capital adequacy ratio, our results indicates a CAR close to 13.2, which is 18% lower than the actual practice in the Brazilian financial market, but is also compatible with Basel III standards. And in terms of motivation, I think it's really important to understand how financial institutions in general affect systemic risk, especially in times of crisis. In Brazil, for example, we have a very robust and well-capitalized financial system with also a considerable high concentration in our market, with this metric in the last 5 years close to greater than 65%. And these and other factors in conjunction limits the occurrence of banking failures in Brazil, which is since 2000 close to 18.2%. And however, I think it's important to strike a balance between safety and efficiency to avoid unintended consequences, as we are just speaking about, between banking concentration and elevated capital cost. And taking this into consideration, this paper has two main questions. The first one, it is, what are the key factors of bank runs in the Brazilian financial system? And the second one that we are going to try to address is, how can regulatory framework be optimized in order to enhance banking competition, social welfare, while maintaining a stable financial system? So, in terms of approach, we begin by estimating the more traditional systemic risk measures in the literature, which is the S risk, systemic expected shortfall, and conditional value risk (COVAR). And although these metrics are very well known and very good to risk ranking each financial institution, and also to summarize very huge amount of data into a single statistics, they are only applicable to listed financial institutions. And for the Brazilian case, this is only applicable to 13.2% of the entire financial system. And although one could argue that because the market is concentrated in 13.2% of the financial institutions accounts for 80% of total assets, there are a representativeness in terms of total assets, but there's a lack of representativeness in terms of total numbers of financial institutions. And in order to address this challenge of representativeness and also try to establish a framework for accessing systemic risk, we propose our model that accounts for idiosyncratic probability of default and also contagion channels using only public available data. So this is a summary of how our model works. So this is a very close to how portfolio risk is calculated in financial institutions. So you have three main components here: the probability of default, PD, the loss given default, EAD, loss given default, LGD, and the exposure at default, EAD. And these three parameters combined gives the expected loss, and through a Monte Carlo simulation, we just build the loss distribution of our economy. And we are here, the probability of default, the idiosyncratic probability of default given by the maritime structure model. And we are constructing the contagion channels through three main stages: the short one, the midterm, the long run. In the short one, we try to capture the panic and market similarity effect through a clustering technique. And we just jump into the midterm, in which we try to capture the interbank network and try to reconstruct the interbank network of the Brazilian financial system using public information from the central bank. And also, we have in the last stage of contagion, the funding and liquidity, which we try to capture through the net stable funding ratio parameters for, once again, all banks. And this is the dynamics of how our models, when implemented, works. So consider, for example, a probability of default equals to 30%. This would yield an associated probability function of minus 0.5. And if you just take random draws from a normal distribution, all the times that this random draw would be lower than this minus 0.5, then the bank would enter in default. Every time that this random draw would be greater than minus 0.5, the bank would survive. And if you just take this, let's say 100,000 scenarios, you would converge to the probability that you are just assigning through your entire process. Yeah, once again, in terms of data, we are using public available data. So it's imbalancing panel data from 2000 to September 2022. All exercises are just for each database, but we have also some kind of parameters that we use this window. And we are here going to discuss two main exercises. The exercise number one, which only deals with a reduced sample of 24 listed financial institutions. And we are going to look at a second exercise that is going to consider all full sample of all the 182 member financial institutions that are covered by the deposit insurance in Brazil. So this is just a preliminary information and statistics for the exercise number one of reduced sample. And here we have some kind of basic statistics. We have here two main information. The first main information, the structural probability of the default of Merton model. And here is the bank probability of default of our bank run model without contagion and with contagion. Here the mean of the structural probability of the Merton model would be 12.45. And here we would expect, if the model works, that this would be very close to without contagion process, because here we just have 24 financial institutions. We see a different second decimal, but when we are just considering the 182, this is going to be equaling lots of decimal numbers. And here we have the contagion process, in which in our model we calibrate this 27% of aggravated probability of default. This measure is not well discussed in the literature. Engel and co-authors uses 40% of stress scenarios for the US. And considering the crisis of 29, the Great Depression, and also 2008. And here we just simulated 27%, and then just talking to Archa and co-authors, this is a reasonable structure for the Brazilian financial system. And here, concentrating in more interesting results, this here would be all measures in reais billions. So this, we are going to consider all banks, the systemically important financial institution banks and non-systemically important financial institution banks, following the criteria of the central bank, which is given by the assets in relation to GDP. And here we have two main informations, the panel A and B, without and with contagion process. And here the idea is when we consider all banks, because we are dealing mainly with the listed one are the greatest one, we have without contagion process capability of the DIA to bail out roughly 99.8%. And here with contagion process, this would drop to 89% of simulated scenarios. And here we are talking about bailout because we have listed financial institutions, we are using the asset risk measures by Engel and co-authors that gives the amount of capital needed in a moment of stress for a bank to operate normally. So this is the reason why we are talking these terms. And this is the second exercise that we have the same idea. And here we have, once again, the means of structured preventive default of Merton model equals to our bank run model without contagion. And here we have some ideas from eligible and covered deposits. Of course, only eligible deposits are disclosed, and we have a proxy using public available data for covered deposits. Here is proxies of almost 54% of total eligibles is close to of total eligible deposits is close to covered deposits in an overall view. And here we are also dealing the same idea. Panel A without contagion process and panel B with contagion process, in which the DIA would be able to reimburse 99% of the simulated scenarios without contagion process and 97% of the simulated scenario with contagion process. And this is the last exercise that we propose in our model, in which we have here two main scenarios, the base scenario and the boundary scenario. The idea here is a trade-off when you just increase the capital requirement, we increase the cost of capital. Of course, you can increase the banking concentration and then have a drop in the loans from banks and increasing your spread, but you have also decrease in probability of default of each bank. So if we get this trade-off in which the next marginal cost is greater than the marginal benefits, then we find an optimized scenario which is close to 18% lower than the actual practice in the Brazilian financial market. So in terms of, just to ramp up, the contribution of this paper, it was trying to offer a framework of different contagion channels and how can we account for idiosyncratic probability of default of institutions, and also using both listed and non-listed financial institutions using only public key data. And we have here two possible, and just would like to share with you, applications. It could be used to calculate what would be an optimal fund size for deposit insurance agents in each economy. And also we could use this to calculate corresponding premium if you have some kind of micro traditional model. And we can also customize this framework to incorporate country-specific factors. And through this, we can try to capture the distinct realities and challenges that each economy has. So thank you so much for your attention.
Thank you, Wesley. You did pretty good on time. So let's have Marcelo.
Thanks for the organizers of the conference for inviting me to discuss this paper. My name is Marcelo. I am from the Federal Reserve Board, and the views expressed here are my own and do not represent the views of the Federal Reserve Board or the staff of the Federal Reserve System. I am a consumer of this type of literature, so I'm actually happy to read the paper for my own interests. And the main questions I saw in the paper were, how much does each Brazilian bank contribute to the systemic risk of the Brazilian financial system? How do estimates based on market prices and balance sheet data differ? And there's an extension in the paper about optimal capital requirements for Brazilian banks. So I will have only one slide talking about the main features of the paper. The paper provides estimates of systemic risk contribution of each bank. And in general, these estimates are based on market prices, bank stock prices in particular. But these papers have limitations because only public banks have stock price data available, of course. And also because some price movements in stock prices are not related to systemic risk, so they can drive the results in a way that it's not related to what we're trying to measure. So what Wesley does is to propose a method to estimate the contribution to systemic risk based on public data, but balance sheet data. And it's a distance default model, which, and by that I mean you have a value of assets, you have the value of liabilities, and once the value of assets gets too close or below threshold for the value of liabilities, then the bank fails. And with this model, Wesley generates loss distribution for banks and optimal capital requirements. So this is the paper in a nutshell. So I'll give my comments, my suggestions from now on. So the first thing that I think jumps out to me is that the estimates of the probability of default of individual banks are very high. And I don't have a problem with that per se. I have papers I wrote with estimates that may be too high, too low, relative to what people expect. But when that happens, you need to discuss that. And actually, you learn more from the discussion, from the explanation, than from the result itself. So to give you an idea, banks in Brazil have stayed close to a BB rating, and historically, the PDs, the actual default rates for companies with this rating are much smaller, as you can see here. From data from S&P. So I think that some more discussion about what drives this number would be welcome. Actually, Wesley does that. I need to emphasize that. He did some of that, but I really want something like what are the assumptions of the model that are driving this, and what can be changed. And when you change the assumptions, what happens to the estimate. So comparison between estimates. Going back to my point, the systemic risk models generally use market prices, and they can be criticized because only public banks have stock prices. This is something that Wesley did in his talk. There's another aspect that to me is very important too. Some price movements are not related to systemic risk. So for instance, during the COVID crisis, the Federal Reserve prohibited banks from doing share buybacks, from banks buying their own stocks. And that, of course, lowers the demand for bank stock prices, but makes banks safer. At least that was the motivation for the policy. And but if you take the bank stock prices in this model, and you see a drop in the stock prices, that would the model would assume that in the other models that Wesley is comparing his work to, if you see a stock price dropping, that would be associated with higher bank risk. That would go in the opposite direction of what this policy from the board was trying to do. So in summary, there are some price movements that are completely unrelated to systemic risk and can go in the opposite direction of what you would expect. And that affects the results of these models that use bank stock prices to measure systemic risk. So that's an advantage of Wesley's work, and he should emphasize that. Now, it would be very nice if you could have a table in which you could show that your estimates are robust to these types of movements, while other results are not. Regarding the optimal capital requirement, the main trade-off was unclear to me when I read the paper. It became clearer when I saw your presentation now. But this is the sentence you have in your paper describing the trade-off. We estimated the minimum capital requirement that maintains stable the relationship between S risk and the economy's loss distribution, and that takes into account the international framework of Basel III. There's a lot in this sentence. I wanted to have something more intuitive. Usually we think about optimal capital requirements as the optimal capital requirement will balance the trade-off between financial stability and credit supply. So if you could put that intuitively in your paper, I think it would be a gain. Overall, I think what I'm getting to is that you need to bring your results to the forefront. Your paper is about your results. There's too much about the method, the model. The model is very complex, and so it takes a lot of time. The results appear for the first time on page 41. So this looks like an editorial comment, but it's not. It's really about the fact that there's a lot going on in the model. So you could think about what you really need to get what you want to. So in the model, there is contagion, there's panic, there's the network structure. So think about what all these things are really adding to your model, and if you can simplify some of these things. In conclusion, it's a nice paper based on, should be a very important question for policy and research. Again, I am a user of these metrics in my work at the board. There are other people in the Federal Reserve System who use this type of measures of financial risk, of systemic risk. Wesley really goes in the right direction. He's trying to produce another measure that does not rely on some information that can be misleading in critical times. His results are interesting. The model does take you step by step throughout his intellectual exercise, but again, just make the results appear more. They need to take the central stage. That's it. Thank you.
Thank you, Marcelo. Wesley, you want to comment?
Yeah, thank you. Thanks so much, Marcelo, for the very rich and insightful comments. Thanks so much for that. And regarding your first point of the PD being too high, of course, I think measuring probability of default of several economies, Brazil, for sure, it's mainly difficult because we have very low frequency of observations of liquidations. So, and it's a very small portfolio, right? So how can we have just 1% of default, 2%? If you have 1,000 clients, it's pretty more easy to get the probability of default. But it certainly is a challenge. Normally, the Merton gives an upper bound of the probability of default because of several conservative assumptions. But I think you raise a very interesting point to try to have much more discussions and a table to compare what this probability of default would be in relation to the listed financial institutions that have CDS, that have much more tools to access probability of default, and compare these measures. So thanks so much for this. I think it's very insightful. Also, thank you for the suggestion about emphasizing that also prices are not in movement with systemic risk most of the time, so thanks so much for this. In relation to the optimal capital and trying to explore more and to try to not have too much dense sentences, I think this is a great suggestion as well. And for sure, the shorter version of the paper should be at least 15, 20 pages at a maximum. So thank you for your suggestion. And also make this, make a better dress for the bride, right? I think this is very important to have a better presentation of the results. So thanks so much for these indications. And because the paper was trying to be very step by step in terms of the construction of the model, because it's not so usual to have these steps disclosed in the literature. I think it was at least helpful for me to understand really the process of each of the steps. But I think that once are done, this could be a working paper and also a more shorter version concising these steps. So thanks so much for this.
Thank you both. Now we open for questions. Professor?
Just one follow-up, in fact, on the discussion of Marcelo, that maybe the truth is between the market prices and the accounting. No, I mean, the problem is that we don't know closer to which ones we are. No, and something which is difficult to do, but maybe would be worth thinking a little bit more, is how to correct potential overshoot of the market prices. Maybe in some of the markets which are thin, no, so this may be an indicator, no, that they may be more overshooting. Or if you have some indicators of market sentiment, no, that no, boom and bust. So maybe there is something more to do, no, to kind of modulate market prices to adjust, to address what Marcelo was saying.
Questions for the audience? So, Leslie, you want to comment?
Yeah, for sure. Thanks so much, Professor. I think this is a great suggestion. There is certainly a great challenge to incorporate the markets, in fact, market sentiment analysis in the calculation of the probability of default, but I think it's very insightful for the Brazilian case, especially. I think that we have some research fronts that are going to try to go in that direction, but there are information challenges to grab and to access in an insightful way and a standard way that we are just working on it, but I really appreciate your comment. Thanks so much for this.
So, Renato?
I was just wondering that I didn't read the paper, but my understanding is that the analysis is purely statistical, right? You're looking at correlations on accounting measures, and you're estimating default probabilities based on that, right? I would suppose that perhaps an exercise that could be also informative is to think about different scenarios. For instance, stress on because of interest rate risk, or some particular issue on credit markets, and to think and perhaps to use your model to see which set of institutions would be mostly affected, what contagion patterns would follow. So perhaps to in a sense guide the reader and guide policy by describing different, let's say, fundamental issues that drive the financial stability.
Yeah, for sure. Thank you for your question. And the probability of default is calculated using balance sheet information for the Merson model. So it's just the idea of when the equity is going to be gone, and this is the moment that the institution would be in the default. Of course, it is not completely when equity it is 0 or slightly negative because we use a concept of the stress barrier that is known in this literature to have assets being much more lower than liabilities to occur the default. And I think your suggestion is really interesting because we could try to capture these reactions to market movement in the first stage of a proposal of contagion process that involves a clustering technique. So we have some balance sheet information to the cluster. We have also some, for the listed institutions, we have some metrics that can be constructed through market data. And I think this is a great option to discuss and to explore more in this first part of the contagion process in the clustering technique. Yeah.
So I'm going to ask one. Wesley, your Y variable is consistent only from defaults, actual defaults, or you have a wider construction for your variable?
Yeah, the Y variable here, it is only the default given by this structural model. So we don't make use of the low frequency that we have in the market because this would be a Camel's approach or something, a regression approach that we have this, but rather it is a model that tries to accounting for assets, liabilities, the assets volatility, and also the returns of interest rate to calculate what would be the probability of the assets being lower than this stress barrier, which is a fraction of total liabilities. So it is a much shorter step besides constructing observable low frequencies and try to inflate this variable and constructing a Camel's approach for this is more a shorter approach.
Okay, thank you. I made this question to try to come up with a better sense of the result of the 12% probability of default that for us it seems a little bit big.
Yeah, for sure.
Okay, so let's go for the next one, Marcelo, from the Federal Reserve Board.
Thank you very much. Again, I'm from the Federal Reserve Board. This is a paper that I wrote with two colleagues from there. It's about the regional bank crisis of last year. And in this paper, we argue that there was a flight to safety, and we'll use proprietary data from the board to show that to you. So to recap, last year, the bank sector went under stress in March. Several regional banks experienced runs, and some of them failed. And three of them failed in March. There were Silvergate Bank, Silicon Valley Bank, and Signature Bank. And in May, First Republic also failed. Three of these failures are among the 4 largest in US history. And after these events, the discussion about the causes started. The main culprits were large unrealized losses on banks' balance sheets because of rising interest rates, and also the reliance on uninsured deposits. So we use confidential weekly data on bank balance sheets from the Federal Reserve to study deposit growth in early 2023. We document a flight to safety to the largest banks in the weeks of heightened stress. We find that greater reliance on uninsured deposits predict slower deposit growth in certain weeks in March 23. And we are still debating with some questions about why largest banks are perceived to be safer. It's a very subtle point. So you can think that people thought they were safer because they had better fundamentals, but we can rule it out actually with some metrics. I will show you that some of their fundamentals were not better than the fundamentals of smaller banks. You can think that they are subject to stricter regulation, supervision, and even though that does not show up in some numbers, that may still make them safer. Or you can simply think that they benefit from implicit guarantees because they are too big to fail. So I will leave you with these explanations. So first I want to establish a fact. In at least one way, this event was unprecedented. So these are this is the regression of growth rates of deposits, and this regression has bank fixed effect, a time fixed effect for each week, and what you're seeing in this chart is really what is left once you control for these fixed effects. So this, you can think about the average growth rate of deposits at banks once you take out any time effects and bank fixed effects. So you see that at the rightmost end of the sample close to where our sample ends, there's a big spike there, the highest in the sample. So the growth rate of deposits at large banks relative to smaller banks, and that's what this chart is showing, the differential effect of large banks relative to smaller banks. So this difference in growth rates at large banks relative to the smaller banks reaches its maximum value in March 23. So I will talk briefly about the literature just to give you an idea of where we think our results are. There's a literature about flight to safety to depositors that is not specific to this recent crisis. It was already started many years ago, but we contribute to it. There's a growing emphasis on work using higher frequency data from banks. So generally, empirical work with banking data are based on quarterly regulatory data. We're using here weekly data. It's a very sensitive data set from the board. And there is a nascent literature on regional break prices of 2023. Of course, there are many papers now being written about those events. So our hypothesis is that there was a flight to safety by depositors towards large banks in 2023. This is what we're trying to establish here. And according to this hypothesis, banks, the largest banks, they received more deposits than other banks, not because they are safer, not because of characteristics they have, but not because of rates they offered, but simply because of some intrinsic characteristics they have because of their size. So we will try to rule out fundamentals to the extent possible. And how we're gonna test this, we're gonna create two testable hypotheses. One is that large banks' deposit growth rates should jump relative to the other banks in periods of heightened stress. And these rates should return to, these differences in growth rates should return to normal levels when stress recedes. And the other hypothesis that is very important too is that these large banks should not offer higher rates during those weeks of higher deposit growth rate. That is, they're not trying to bring depositors to their own banks. So the deposit interest rate should not be able to explain any spikes in large banks' deposit growth relative to the other banks. So talking about the data, the main data set is the data collected through this FR 2644. So in the US, the Federal Reserve collects on a weekly basis a simplified balance sheet from a sample of banks. So participation is voluntary in this data collection, and that's why we need to be very careful about what we review about these data. I cannot even tell you which banks participate in this exercise. We're also going to use weekly deposit interest rates from RateWatch. RateWatch is a vendor that collects data on deposit interest rates. We're going to add quarterly balance sheet data from regulatory reports, and we're going to use some measures of deposit market concentration from the FDIC, which is the US version of the Fundo Garantidor de Crédito here in Brazil. So we restrict the data to domestic banks, also to commercial banks, which are subject to a homogeneous regulatory setting. We drop bank holding companies in which the commercial banks account for only 6% of its assets. So let me explain it briefly. In the US, there's this legal entity called the bank holding company, which may have different commercial banks as subsidiaries. So we're going to treat all commercial banks that belong to the same bank holding company as a single individual in our panel. And we're going to drop banks in mix that they acquired or merged with other banks. Data start in the beginning of 2023 and goes until March 3rd. Again, it's collected as of every Wednesday of each week. We're going to separate banks into 3 categories. The small, which are under $100 billion in assets. The regional, which are between $100 billion to $50 billion in assets. And large, which are above $250 billion. We wanted to use a stricter set of large banks, that is to subset to the G-SIBs, global systemically important banks, but we were asked not to. So the large banks comprise some banks that are not as big as we wanted to. We're going to define the weeks of stress as the weeks of March 15 and May 3rd. These are during these 2 weeks, 3 of the failures that I talked about happened. And these are also the 2 weeks in which the KBW regional bank stock price index dropped the most, as you can see in this chart. To give you an idea of how the frequency of the data helps us, we did this timeline here. Every bullet is a date of data collection, and every red bullet is a date of data collection that has an interesting event. So we were able to collect data, let's say on the week of March 8, when Silvergate, the day when Silvergate was liquidated, and SVB disclosed a plan to raise capital, and then in March 15 we have data again, and this is between March 8 and March 15 we had the SVB failure, and Signature Bank failed in March 20, so March 12. So we have this frequency of data that can help us separate effects of bank failures from, for example, the decision of the FOMC on March 22 to raise interest rates. We're going to run a regression that is very simple. So the main variable, dependent variable of interest is the growth rate of deposits at a given bank in a given week. And we're mainly interested in this coefficient beta, which measures the difference between the growth rates of large banks or regional banks relative to small banks in that given week. We add bank fixed effects and time fixed effects. And the testable hypotheses that we use are shown at the bottom of this slide. So first, when we use as the dependent variable the difference between the growth rate of large banks relative to small banks, then we expect that we will find this beta to be positive. That is, during a week of stress, the large banks, they receive an inflow of deposits at a rate higher than the small banks. And the second hypothesis is that when we use the deposit interest rates as the dependent variable, then this beta should be non-positive in a week of stress, which means the large banks are not increasing their interest rates more than the smaller banks. They're not doing an effort to attract deposits during those weeks in which they received higher inflows. So our results, before I show you the results, I just want to mention a few things. So first, this period of time that we are analyzing, during this period, banks were already experiencing a decline in deposits. So you see that the mean growth rate of deposits throughout the whole period is negative. So the board was already tightening interest rates, deposits were going out of the system, there was a diminishing liquidity in the market, so deposits were already going down throughout this period. Also, we have here the products that we're gonna, the deposit products that we collect interest rate data on. So we have CD rates and money market rates, and these data are from RateWatch. So let me talk about the structure of these charts that I'm going to show you. We'll use the March 8 as the reference date, and these charts are gonna show you the difference between growth rates between large and small banks. So we normalize this difference to 0 on the week of March 8. So you always see the red line touching the horizontal line of 0 on March 8. And everything that I'm going to talk about is relative to March 8. So what you see here is that right after the week of March 8, on the week of March 15, when SVB failed, there's a jump in the difference between the deposits growth rate of large banks relative to smaller banks, consistent with our first hypothesis. And at the end of this period, on the week of March 3rd, when First Republic also failed, then you also see a jump in this difference of growth rates between large banks and small banks. So this chart supports our first hypothesis. Now, what happens when we add to our regression equation controls for those bank characteristics that people pointed out as responsible for some bank failures? So when we go from column 2 to 3, we add to the regression the ratio of uninsured deposits to total deposits at each bank. And when we go from 3 to 4, we add the tangible common equity ratio, which is a measure of how much equity the bank would hold if it had suffered a big loss in the value of its assets because of changes in interest rates. You can see that the main coefficient we're interested in, which is the interaction between large and the March 15 week, does not change much when we move from the left to the right. And the same happens to the coefficient on the week of March 3rd. So these estimates of this differential effect are robust to controlling for these bank characteristics. So it means that there's something in our result that survives when we account for these bank characteristics. Let me skip this and go to the other hypothesis I wanted to test. So what drove faster deposit growth rate at large banks? Did large banks compete more aggressively by raising interest rates during those weeks? So we're going to test this hypothesis that the beta is now non-positive in those weeks of heightened stress. We're going to use different specifications of the paper, but I'm going to show you the results in which the dependent variable is simply the interest rates on deposits. So there are two panels here. I'm showing you on top the interest rates on 12-month CDs, and on the bottom the interest rates on money market deposits with a minimum of $10,000 of deposits. And as you can see, during those weeks of heightened stress, the difference between the interest rates offered by large banks is either flat or is declining over time. So the biggest banks are not increasing their interest rates relative to smaller banks in order to attract deposits. And this supports our second hypothesis. So we argue in the paper that this evidence that I've shown you supports the idea that there was a flight to safety by depositors towards larger banks. There are different explanations why they can be perceived as safer. They may have stronger fundamentals, tighter regulations or supervision, and implicit guarantees because they are too big to fail. We haven't been able to really identify the main reason, but I'm going to show you something that goes against the idea that largest banks had better fundamentals. So this panel, I'm going to show you the mean uninsured ratio for large regional small banks and the mean adjusted TCE ratio for large regional small banks. So you see in the column in the middle that larger banks actually relied more on insured deposits than smaller banks. This is a fact that is very well known, but it's worth emphasizing. And also, their adjusted TCE ratio was smaller than the ratios of smaller banks. So the fundamentals clearly are not the reason why larger banks received an inflow of deposits relative to smaller banks. So in conclusion, the paper gives evidence of a flight to safety by depositors. The bank run did not cause a widespread run on the banking system, but may have long-run implications for concentration in the bank sector, financial stability, credit availability, regulatory reforms, and we're still working on probing the causes for those movements, and we're also going to study credit supply implications of this deposit reallocation. So thank you very much, and I look forward to your comments.
Thank you, Marcelo.
Right, thanks a lot for the opportunity to read and discuss this really, really interesting paper, which is an important read if you're interested in the US regional banking crisis. This paper is about the study of bank deposits after the onset of the regional banking crisis, and it uses really novel weekly banking data. And the key interest of the authors is in the week of March 15. That's when the Silicon Valley Bank failed, and when also Signature Bank and one more bank was in troubles. and in the week of May 3, where First Republic Bank was taken over by JP Morgan Chase. So the key interest is in the deposit growth at the large banks during the times of stress at the regional banks. And Marcelo was showing you this graph before, and we really see that those large banks enjoyed a very strong deposit growth exactly at the time when Silicon Valley Bank failed on March 15. The suggestion here really is that the outflows from the small regional banks ended up with the large banks during this period of stress. What do the authors do in this paper? The authors use confidential weekly balance sheet information for commercial banks. So they actually don't observe the deposit flows from one bank to the other directly, but what they have is balance sheet data, weekly reporting, and that's from the Federal Reserve, confidential data. The authors, they also don't observe flows to non-bank financial institutions like money market funds. We can't learn about aspects like cash sorting that also played an important role there, and I will maybe come back to that. The key variables are first, deposit growth rates. Second, the rate watch benchmark deposit rates for 12-month certificates of deposits and for money market deposit accounts, which are slightly less liquid and come at a higher rate. And the benchmark rates are for $10,000 account size, so that's kind of a retail type of benchmark for insured deposits, right? Another key variable is the adjusted tangible common equity, which accounts for unrealized hold-to-maturity portfolio losses, and the uninsured deposit ratio. Then bank size plays an important role, so they're the large banks of a size larger than 250 billion, the regional banks in between 100 and 250 billion, and the small banks below 100 billion. And the authors are also using granular bank and county level deposit market concentration measures in their panel regressions, which they are running with bank and time fixed effects. In terms of the main findings, a key question is why are the largest banks perceived to be safer? That was also showing up on Marcelo's slides. Against the backdrop of the literature, there's a large literature that looks at determinants of bank failures and contagion, that is the spread of a problem at one bank to another institution, right? What really was striking me first in this, in the reading of this paper, was the role of institutional similarities. So you really see that institutions that were similar regional banks got into troubles, and certain institutions with certain similarities, specifically the large banks, actually enjoyed a lot of inflows. And it didn't seem to matter so much whether the large banks have really good fundamentals or not so good fundamentals. So they were all put into this institutional basket, large banks, and they got a lot of inflows. And against the backdrop of this existing literature on contagion, this paper is in a way on negative contagion or flight to safety, meaning that certain type of banks are under stress, and the depositors of those banks, they are flighty and move their deposits to the safer banks that they consider as stronger. What the authors find is they find evidence supporting a depositor flight to the relative safety of large banks. They find faster deposit growth at the large banks, which isn't explained by the uninsured deposit funding ratios or by unrealized mark-to-market losses. So depositors don't seem to discriminate here. The authors also find that effects are lasting on the bank funding side, and that uninsured, the moves of uninsured depositors suggest to have played a key role. Finally, they find also negative effects on the supply of credit, but as Marcelo said, they will also work some more on that in the future. pin that down better. So let's come to my comments. First, as Marcelo explained you nicely, there are two aspects to this flight to safety hypothesis. First, the authors were doing deposit growth regressions, and second, they were conducting interest rate regressions. In the deposit growth regressions, the idea is to find evidence for an increase in the growth of deposits with large banks if there is a stress in a given week located with the regional banks, and this shouldn't have been due to better interest rates offered by the large banks, so it should really have been a flight to safety move. A potential concern for the deposit growth regressions is seasonality, so I'm quite convinced that the strong effect around the 15th of March that was documented by Marcelo graphically in his presentation is really there and meaningful. But when looking at the table, I see that there is a strong seasonality beginning and mid-month. And the two dates, 15th of March, mid-month, and 3rd of May are really falling in the seasonality pattern. And, when thinking about this seasonality, what plays a role there is seasonal payment patterns, and they might also depend a lot on the bank business model. Some banks have a lot of household deposit accounts. They get a lot of inflows in a week when, paychecks are due, and aspects like that. So there's a lot of relevant bank heterogeneity and common factors for some of those large banks that are of specific interest in this study. And here I recommend the authors to try to dig a little bit deeper. Unfortunately, it's not possible to have bank times week fixed effects, which could take care of that. But maybe there is some other dimensions in which the authors could go more granular, for instance, when it comes to the duration of the liabilities of the banks, other aspects related to the business model or geography. I also would be curious to see additional controls, liquidity controls on the asset side. So far they are only liability side liquidity controls, and also something on the maturity mismatch would be interesting to see for robustness. Then when it comes to the interest rate regressions, it was for a while a bit unclear to me when reading the paper how much is actually about insured versus uninsured deposits. And the authors can also, in part of the analysis on the weekly data, not distinguish here. And this is against the backdrop that the benchmark interest rate data is for insured deposits, right? For retail deposits. And we expect that actually most of the moves were by uninsured depositors, by larger depositors, right? And then, of course, the question is, could it be that the large banks increased their rates on wholesale deposits and that was causing the flows? I think that's very unplausible and very unlikely, but maybe that's just something to be mindful about. Then I have some smaller comments, which are on the small increase in the interest rates by large banks for the week ending in March 15. And I actually think that could be related to rate hike expectations, and I think it's generally interesting to look a little bit more into changes in interest rate expectations for the different weeks. Of course, there's the FOMC announcement that Marcelo showed us on the table, right? But there are also relevant changes in interest rate expectations, especially in the 1 or 2 weeks before the announcement. That did play a role, and that can differentially affect large and small banks and banks with different business models. To conclude, I really liked the paper. I learned a lot from it, and I really recommend it as an essential reading. For you on the US regional banking crisis, Marcelo's paper conducts a rigorous empirical analysis, and it advances our understanding of depositor behavior in crisis times. And it's really interesting to look at this flight to safety dimension. There has been a lot of interest in the literature on the spillover of crisis from one institution with troubles to another institution with troubles. And really here we see this negative type of contagion channels that have been studied less. I really think that this paper is an important piece that informs the ongoing debate on banking stability and regulation, and it's specifically of interest when we think about the design of deposit insurance schemes and the extension of deposit insurance, and about crisis management frameworks and crisis management measures, and that's maybe also where the paper could try to tease out a little bit more going forward. Thanks a lot.
Thank you, Christoph. Let's collect some questions from the audience, and then you address all of them. Questions, Professor?
I have a
Oops, I'm sorry. You go first.
Okay, thanks. Marcelo, it was a very nice paper. I was wondering three things. So the first one is, if you observe, or I don't know if your data allows that, if the deposits remain in those large banks after the crisis recedes a little bit, or if they return to or go to other regional banks, right? That's one thing that I think was interesting, would be interesting to see. The second one was also about the fundamentals, which is kind of similar to the other comment about if you have on top of, you already put the adjusted TCE and the uninsured, so I was thinking if you could add like Hamill's ratings or the composition of the bond portfolio, just because the bond portfolio was the issue, right? And also, if you are able to use cash transfers data, so from the payment system, so if you can actually observe the money flowing from the regional banks to the large banks.
Professor?
So very interesting. Just one observation, which I think, I am not sure you've looked at what is consistent with the explanation that the flows from the regional banks to the large bank were not because the large banks were safer. If we look at the measure of liquidity risk, which in fact we have looked with Viral Acharya in a report we're finishing on the banking turmoil, which is basically the demandable uninsured deposits versus reserves and liquid assets for banks in different categories, then one sees that for the smallest banks, in fact, below 50 billion, the liquidity risk goes up. But both for the largest and the medium, it goes down, and for the medium, is below the largest in a clear way. So this would support your interpretation.
One more there, and then we go for answers.
Yeah, actually, a quick comment on the lady who made a comment there. Tom Eisenbach has a paper looking at the payment flows and this exact period. I was also to question whether this is necessarily all safety. I do think it's mainly safety, but at the same time, if you have to move funds very, very quickly, you're going to go also to the banks that you know. Okay, if you really have to get stuff out of your regional account, you're probably not going to go out and research lots of other regional accounts. You're going to go to a large bank, regardless of safety, because you have the scale to onboard for one. So maybe some information on new account creation might be interesting. But of course, a lot of companies have accounts with multiple banks in the same way they borrow from multiple banks. They're very, very quick to substitute when one bank among multiple they have relationships with worsen their lending conditions. I imagine they're very quick to substitute their deposits as well. My guess is if you look at the distribution of how many banks individual borrowers have, a lot of people have multiple banks, and among those they're always going to have a big national bank. So some of this may just be I have two accounts, I'm just going to leg it straight to the national bank that I've already got. So I think these things are connected to safety, but I think they are distinct from safety, and they're much less sexy, but like them, it's probably a big part of it mechanically, administrative issues like that.
You can address them, Marcelo?
Yeah, okay. So first, well, I'm not going to answer all of them. I'm going to answer those that I was quick enough to prepare a half-baked answer. Christoph's comments, he asked about seasonality. I think that was the main issue. I fully agree. There's actually, in the US, there's a quarter-end pattern in banks that is very pronounced, and it shows up, probably is showing up in the first week in the data, which ends in January 3, but covers the year end. So that's something we have to think more about. I don't have a good answer to give you now. Another thing that you raised here, our data are very simple. So the weekly data do not distinguish between insured and uninsured deposits. What we used in the results you're seeing is the fraction of uninsured deposits in the latest call report, the latest quarterly filing of the bank. And so my co-authors and I are applying to use some other data set that the board has that is also confidential, that distinguishes between insured and uninsured deposits. It's collected at a high frequency, but for a smaller set of banks. So there will be another version of the paper that tries to address this. And so let me go to the first comment from the audience. You asked about persistence of deposits. Again, the version you're seeing is either the first or the second that was approved for distribution. So we had the sample up to the point you're seeing. We plan to write a new version of the paper using more recent data, and then we'll be able to say something more about persistence of deposits, which is a very crucial question in the literature. Manju Puri has papers on this, and she uses a longer horizon because she's very curious about persistence of deposits. So camels or bond portfolio, camels is something we're trying to avoid because it's another data request, also confidential. It may reveal the sample of banks we have. We don't want to do with that, but we may look at the bond portfolio more carefully. And the cash flow data, there is the data we have do not include flows, only the stocks. We would need to match with another data set. I don't know if that would work because it would restrict the sample of banks a lot too. Professor, so about the metric you suggested, that you said it may support our thesis here. I think I need to look at that before I can say.
You'll need uninsured deposits, obviously.
Yeah.
So that's
let me think about this. And so in your question about whether it's really a flight to safety, it's a good point. Some people ask me whether, in a seminar, someone asked me whether it was actually a flight to size, not safety. It may be just the convenience of putting your money in a bigger bank. And actually there is someone with a paper out showing that there's an effect of whether the bank has an app or not on the flow of deposits. So I think these questions are relevant. We need to think about it.
And it goes back to her first point that actually the reversion might actually distinguish some of these things, because if it's that you don't know about the other small banks in your area, immediately you're going to move, but then once you learn about them, you might move back to them.
Yeah.
So that'll distinguish it.
Yeah. Okay, thank you so much.
Thank you everybody. Thank you the speakers. Thank you the audience. We are short on time. It's time to go and have some lunch for the afternoon. Thank you very much.